I mean, this is pretty bullish, right? I mean, I think Monday morning, I'm not sure everyone expected the market was actually going to rally.
I did.
Because you read my notes on Sunday.
No,
Maybe.
I didn't.
Because I was pretty bullish on Sunday, too.
All I said was this, to me, seems like an incredible positive for the world.
But my ego told me it was my notes. But I did hear your show on Monday.
Actually, I read your notes regularly, and I agree with your assessment that you got to be bullish in this market.
Yeah. Well, I think it's more remarkable. You had John Katz on your show Monday, and he had said oil's going to plummet to the mid-60s, and it was about $75 a barrel at that point. I didn't expect that to happen in 2 days. That's extremely stimulative to the U.S. economy and to the world economy. So I think that's a huge plus for economic growth as we look at the rest of the year. And also, if we're going into earnings season next month, or actually in really a week, and all the analysts have just cut down their earnings estimates. So like we're going to have something like 4% growth from 8% growth. So the hurdle's so low for companies to beat next quarter that I think you're just lining up right now for very good moves in the stock market. And the economic picture looks very good right now because we have lower oil prices. We know the economy is growing this quarter, accelerating this quarter. This is all very, very good.
I will say this. That was a surprise to me that oil prices plunged the way that they did.
It just tells you how quickly the market's been able to price in that this conflict has come to an end. We're not going to cut off the Strait of Hormuz. It's not going to happen. And meanwhile, I mean, again, if you look at the rest of the world, like we have this NATO events coming up, and they're going to double their defense spending in Europe. So there's a lot of stimulative things going on in Europe as well and globally, not just in the U.S., and that's great for everybody.
As much as you guys are both bullish, and you've made this case for so long, Ryan, and you've been spot on. You too, Mike, you've been spot on. I think there is an increasing worry now about debt and deficit. So I wonder if we're going to get an opportunity to buy into this market with another sell-off at some point soon because of debt and deficits and the big, beautiful bill.
Well, I think the problem is bull markets don't let you in, right, at this point. And I think this all does come back to the Fed.
Well, they let us in April.
It was a small window. Institutions were selling,
they let us
which
in.
is crazy. Institutions were selling, and now they need to get back in, which
Some of us bought NVIDIA below 100 at that time.
Wow,
Some
Maria,
of us.
You did.
Not me.
Oh, I thought you were.
Some people who I know of.
I was like, dinner's on you if that was the case. But I think here's the problem, right? The Fed probably is going to cut, and they kind of have to here. And I don't know if it's because Trump's been calling them names or whatever, but we're kind of at our target right now. But when that happens, I've talked about this off air, you have $7 trillion sitting in money market funds that were paying 5%. Now they're paying 4%. They go to 3.5%. That money's going to find its way into the market. So your biggest risk here, I say this every week, is a melt up, not a meltdown.
I like it. Ryan, great stuff. Thank you so much. Ryan Payne here. Michael Lee, you're with us all morning. We're so grateful for you for that. Quick break. I'll be speaking with Citi's Vice Chair of Client and Banking, Leon Calvaria. I mean, Ryan makes a great point. We are now at the end of the first half. Wow. I mean, July 4th is next week. The earnings are going to start flowing out right after the end of June. What kind of a second half are you expecting, Mike?
Spectacular.
Yeah?
So look, it feels like the market's up a lot more because we were down so much and we've had a substantial rally, like close to 20% off the tariff tantrum early this year. But I think year to date, the S&P is only up 3.5%, right? Which is really not a huge move in the overall market, but we're knocking on the doors of new all-time highs. New all-time highs typically bring more new all-time highs, and we have all these tailwinds at our back, especially by the way of rate cuts, where, look, the Fed's 4.25 to 4.5, inflation's trending 2.25 to 2.5, so we're 200 basis points restrictive at the moment, which means at some point either Powell or his replacement over the next 18 months is going to cut the short end substantially. And so you have that against the backdrop of earnings expectations, which are too low.
Yep.
Okay, an improving overall economy, this big, beautiful bill coming in, this inflation and oil prices coming down spectacularly. Enough good things can't be said about that because it lowers the cost of everything. And then these tariffs do spur on domestic manufacturing, which means you're going to get a higher multiplier, all against the backdrop against the largest and fastest growing technology trend in history, which is artificial intelligence. Look, so the stars are aligning perfectly for stock investors.
Yeah, it's a great point. And, when we look at yields this morning and we saw Fed Chief Jay Powell yesterday on Capitol Hill testifying, I felt that it was a little dovish. I don't know. I mean, he was in front of the Senate banking. He'll be in front of the Senate Banking Committee today. So we'll see what he says today. But in front of the House Financial Services Committee yesterday, he said the Fed is still waiting. They could cut rates, but the tariff-driven inflation is still adding to his uncertainty. But listen carefully to what he said. Watch this.
Yeah.
We do expect to show up, tariff inflation to show up more, but I want to be honest, we really don't know how much of that's going to be passed through to the consumers. If you just look at the basic data and don't look at the forecast, you would say that we would have continued cutting. The difference, of course, is at this time, all forecasters are expecting pretty soon that some significant inflation will show up from tariffs. Now,
it's interesting. I felt it wasn't as hawkish as in the past. He says, we don't know, honestly. We don't know if it's going to be, go on to the consumer. We got some economic data today. The housing market has not done well. I mean, the home sales number is out this morning at 10 a.m. Eastern, so we'll see what that brings us. But the fact that he talked about we would have been cutting rates and we don't know if it's going to, tells me that he's beginning to get forced to pivot. It's not because President Trump is saying cut rates, because he's reading the tea leaves.
Yeah, look, I think he's realizing, he's the emperor and the emperor has no clothes. And, when you make all these cuts leading up to an election, only to do an about-face and say it's not political in November, and then inflation is dramatically lower than when he was cutting interest rates last year, and you're still sitting here, well, we're waiting for something bad to happen. We're waiting for something bad to happen, and then it's not happening. How much egg on your face before you reverse course? And so I think this is a positive sign that he sees this, and if I'm Jerome Powell, I'm saying, hey, if this data doesn't, if we don't see an inflation acceleration, we will most likely cut aggressively to get to more of a neutral stance. And I don't think you need to be completely neutral. Remember, neutral is where short-term rates are identical to the rate of inflation. I don't know that he needs to be neutral because we're still above 2%, but I think that the fact that they're above 3 is ridiculous.
Yeah.